Wescott's latest economic and market outlook. I am Mark McCarron, Wescott's Chief Investment Officer. And thanks so much for joining us today. Today is November 6th. And at the time of this recording, we're in the midst of determining the next president of the United States. And we thought we'd focus today on obviously the U.S. election, what the potential outcome of that election might be, and also what the potential market implications may be. So as usual, we're going to follow the same format, a quick market update through today, talking a little bit about how the markets reacted. The second and middle part of our presentation is really going to be focusing on where we stand as of November 6th and the uncertainty that still exists out there with respect to the outcome. And then looking a bit further out, our current outlook today and how that may change or not based on today's news. So as usual, a quick market update, and we're going to focus here really on the quarter to date period of time, just how things have gone over the last couple of weeks. But first, key points to be made: the U.S. election that we've just gone through this week saw record turnout and was much closer than many of the polls had indicated. And as we expected, as many expected, the battleground states are still tabulating the results after Election Day. And that has caused even more uncertainty in terms of what the outcome may be. But the market continues to focus on policy, and we're going to make that point a lot. But the anticipated fiscal stimulus package that was being negotiated in Congress more over the last several weeks failed to pass before Election Day. And the size and the focus of the upcoming coronavirus relief bill, which we think will happen, but it really depend on what the outcome of the election is and the policy goals of that administration. So what we've found interesting is that the initial reaction of the stock and bond markets, at least over the course of this week and as the election results and the voting results came through, is that the markets are finding some comfort with what we're calling a split Congress. So many investors look at that balance of power between White House, House of Representatives, and Senate as limiting any major changes to current policy over the next 2 years, at least until the next election, midterm election. So I think that's really why the market's rallying, to be honest. And it's not because there's a preference for one or the other, but that balance of power is critical. So what we're seeing is, as we talked about in earlier presentations, September was a pretty difficult month. It was a down month, at least in the first couple of weeks. But since then, markets have started to move higher again. And so far in the fourth quarter, they're up significantly. If you look at the S&P 500, up 2.5%. If you look at the broad-based S&P 500, which is equal weighted and broader than just top 5 or 10 names, that's up 3.8%. And on the right-hand side, you can see the sectors or the style sectors that are performing well. Small companies are outperforming large companies, which is a nice change of pace, suggests a broader market. And that's really what's driving this outperformance of the equal weight. But the last couple of days, we've seen stock price momentum return to the technology and the healthcare sector. And really, I think that's because expectations for continued accommodative fiscal policy and monetary policy. We just heard from the Fed's keeping their rates low and unchanged. And that's all being priced into growth expectations for these sectors. And then, as we talked about, the election implication here is that there doesn't seem to be a significant shift in the Senate, which could potentially have led to a change in policy, but in particular policies of taxation and regulation. And so we're going to get into that a little bit in more detail. So the first comment we would make is that this is an unknown result. As we speak today, as we're recording this, there's been no official outcome announced for the presidential race. And we put that in quotes here as of November 6th. These things are changing as we speak. But the presidential, Senate, and House of Representatives election was a very tightly contested race. And the polls, as we talked about, the betting markets that we showed in prior webinars, had indicated that it was going to be more of an impact or more of a what's called a blue wave potential, which meant that the White House, the House of Representatives, which still has a Democrat majority, and then the Senate was the third piece of that was anticipated at least a couple of weeks ago to move into Democratic control. But as we show on this chart on the right, that as of today, the Senate map looks very balanced, and it's uncertain and it's undetermined. There are still 4 seats outstanding and remaining. And in Georgia, there are 2 of them that may be even contested in January. So it's unlikely that we're going to get any confirmation or clarity as to what the Senate looks like up until those hearings in January. And that's really, sounds like a bad result, but the market tends to like balance. So if it were to be that, as it's predicted today, or at least the voting indicates today, if there is a President Biden and the Senate is balanced and remains in Republican control, and the House of Representatives remain in Democratic control, the market likes that. The market likes that balance and checks and balances on power. And I think that's really why the market's not falling dramatically as we speak today, and it's actually quite positive and has been over the last several weeks. So swing states, Michigan, Wisconsin, Pennsylvania, all proved as expected to be the focus of the race, and continue to be today as absentee and mail-in ballots continue to be counted. The market focus remains on economic policy, not on personality, really. So this is, based on the results of the presidential election, the House of Representatives, and the Senate, the likelihood is that there's going to be a split Congress. And we think that that's eased some of the investor concerns. Now, there will be challenges to potential outcomes in certain states over the coming weeks. We're prepared to see some volatility in markets. I think it's important to note that we are not making any major changes in portfolio strategy at this stage based on these outcomes. In fact, the portfolio is built to weather a variety of different strategies. We have some growth opportunities in the portfolio that have done very well this year. We have some defensive strategies that have also held up well during periods of uncertainty. And we also have segments of the market that will do well when there is a broader economic recovery, which is not necessarily related to the outcome of the election, but mainly related to the pandemic and how we ultimately get back to more normal lives. So that remains our outlook. Despite all the uncertainty as to who and which party will ultimately win the election, if you look at what we've been talking about, the pandemic trade, which is we're all doing what we can in the current environment. Technology is doing very well. As a result of that, healthcare is doing very well as a result of that. But the recovery trade is really where the future returns may lie. That includes financial services, energy. It also, retail, travel, hotels, all of those things. We expect to participate further as we recover as an economy from the pandemic. So the economic conditions that we see in the market today are improving. That's coming despite record number of virus case counts, as we saw during this week. Unemployment remains high, but it is dropping. The uncertainty around whether and when additional government stimulus will be added, and the upcoming election, I still say that because it's the elections happen, but the outcome is still uncertain as of today. The equity market strength that we've seen this year comes primarily from those companies doing very well in this environment, yet valuations are getting stretched in our view. So it's important to have something in the portfolio that's not based purely on that. And that's something that a balanced portfolio allows us to do. The fourth quarter trend suggests that the market leadership could be changing. We see the small companies doing better than large companies, although it's really hard to overcome that momentum in growth stocks today. We continue to expect a broad U-shaped economic recovery. And if we do see that and continue to see that, that should result in a broader market, economically sensitive sectors included. So I think, the outlook doesn't change very much. The portfolio remains balanced, it remains stable. We continue to watch the results of the U.S. election, and we look forward to updating you as we learn more in the coming days and weeks. And thank you, as always, for joining us and your trust in Wescott. And as I always say, don't hesitate to reach out to your advisor or to me if you have any questions. Thank you.